This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 30, 2026, and this is the After Hours session. Now, let's get into it. SPY closed at $729.46, essentially kissing the 5-day low of $729.10. We are watching a broad market liquidation, where QQQ dropped 2.4% and IWM tested the 288.26 threshold. But here is the anomaly. The VIX sat at 18.21, completely unmoved by the 1.54% daily drawdown. Today, we dissect that disconnect between price action and volatility, starting with the sector rotation away from technology and into energy. Looking ahead to the close and tonight's prep, the calendar is dense with macro data. First, we had the EFF-OMC rate decision on July 29th, which locked the Fed funds rate at 3.63%. That decision set the tone for this week's pressure. Coming up later today, July 30th, we have three major releases: GDP, initial jobless claims, and the PCE price index alongside personal income. These figures will either validate the soft landing narrative or confirm the sticky inflation pressures we've seen with CPI at 3.46%. Tomorrow, July 31st, we look to the University of Michigan consumer sentiment reading. For now, the market is digesting the aftermath of that hold and preparing for this morning's data print. The director's brief describes a high volatility/sector divergence environment. SPY is at $729.46, QQQ at $661.73, and diamonds at $515.41. Meanwhile, the energy sector stands alone as the only major sector in positive territory, up 1.88% to $58.65. The rest of the lineup, the technology sector, the industrial sector, consumer discretionary, are all deep red. Let's jump into the impact of this divergence. The disconnection here is stark. SPY is down 1.54%, yet the VIX is languishing at 18.21. That isn't stability, that is suppressed fear. Institutional participants are quietly accumulating downside protection rather than capitulating, creating a latent risk for sudden volatility expansion if key supports fail. The sentiment has shifted from the bullish noise around NVDA to a bearish stance on Opal, signaling that this rotation isn't random, it's structured.
I'm looking at the mechanics of that suppression. SPY closed at $729.46, which is merely 36 cents above the 5-day low of $729.10. QQQ is even tighter, sitting just 59 cents above its $661.14 floor. The fact that we have a 2.64% collapse in the technology sector to $166.57 without a corresponding spike in VIX means volatility is being priced as transient noise. That is far more dangerous than outright panic because it allows sellers to exit positions quietly before the inevitable expansion occurs.
And that quiet exit is exactly what worries me about the 4.67% yield anchor. The VIX at 18.21 indicates no organic buying interest is stepping in to absorb the selling pressure in SPY. When volatility finally expands from these lows, it won't be a measured correction. It will be an explosive reaction to the yield shock. A break below $729.10 will not result in a stable retest, but a rapid slide toward lower liquidity pools.
CIPHER, let's talk fundamentals. How does the macro environment explain this sector split?
It's a regime shift. Capital is abandoning duration-dependent growth in technology, which has fallen 7.6% over the last week, in favor of cash flow certainty. The 10-year yield holds at 4.67%, creating a hostile valuation environment for long-duration assets. Meanwhile, the energy sector is gaining 1.88% because it offers tangible asset backing. We are seeing a fundamental re-rating away from tech and toward energy and defensive staples like the healthcare sector, which is up 4.27% this week. The market is pricing in severe margin compression for big tech as the Fed maintains a hawkish hold.
That fundamental erosion is what makes SPY's $729.10 support fragile. You're arguing the support might hold because it's a round number, but you're ignoring that the 7.6% drawdown in the technology sector represents a repricing of earnings power, not just a technical oversold condition. Without a fundamental floor in earnings per share growth, technical support levels are just temporary pauses before further deleveraging.
Exactly, and look at the idiosyncratic divergences. MSFT is gapping up 9.6% on operational news regarding PulsePoint, which is a specific company catalyst, not sector beta. Conversely, XLI is down 20.8% on an earnings miss. In this 4.67% yield environment, earnings misses are being punished far more severely. The fundamental flows are biased toward downside for growth sectors until that yield retreats.
Let's dig deeper into the specific assets driving this action. Starting with the S&P 500 ETF, SPY, it's at $729.46, down 1.54%. Grid, walk us through the technical structure.
We are in a critical support test phase. SPY closed at $729.46, risking a decisive break below the $729.10 5-day low. If we lose that, we target the 10-day range low, which happens to also be $729.10. Overhead resistance has shifted higher to $735.98, the July 28 low, and $739.97, the July 29 open. The short-term buyers have been systematically absorbed. A daily close below $729.10 invalidates the current consolidation pattern and opens the door for accelerated downside execution.
I agree with the vulnerability, but I want to highlight the speed. Because the VIX is stuck at 18.21, algorithms aren't hedging gradually. They are clustered. When the $729.10 floor fails, the lack of implied volatility means there's no buffer. It becomes a liquidity vacuum. We don't see a slow grind down. We see a flash crash profile.
And that flash crash profile explains the sentiment shift. The VIX at 18.21 is a lagging indicator of comfort. Look at the put/call dynamics in the pre-market movers. We saw massive volume in NCRA, 124.8 million shares, which is speculative churn. But paired with the 20.8% drop in XLI, you see defensive positioning in fragmented liquidity pockets. The crowd is not panicking yet, but they are hiding. Once the VIX breaks its recent range upper bound of 20.31, that hidden leverage will rush for the exits simultaneously. Moving to the Nasdaq heavyweights, QQQ is at $661.73, down 2.4%. CIPHER, how are the fundamentals shaping up for the megacap tech component, especially with Apple reporting soon?
The concern is earnings per share sustainability. Apple is scheduled to report an estimated earnings per share of $1.88. Given the 7.6% weekly contraction in the technology sector, the market is pricing in severe margin compression. If Apple fails to justify that estimate in a 4.67% yield environment, the fundamental case for the technology sector's support collapses. We are seeing revenue quality concerns front-run in stocks like Crocs, which is down 11.8% despite strong Q2 results. The market is anticipating demand degradation in consumer discretionary, which aligns with the broader macro fear of slowing GDP growth at 1.5% annualized.
Technically, QQQ is mirroring SPY's distress. It declined 2.4% to $661.73, sitting dangerously close to the $661.14 support level. It failed to hold the previous day's close of $675.49, signaling a loss of upward technical integrity. The volume confirmation is concerning. We're seeing high-volume churn in laggards like FNGA, down 95.1% on 6.4 million shares. This suggests institutional distribution in core holdings rather than organic buying interest. Unless Q can reclaim $675.49, the path of least resistance remains downward.
The sentiment surrounding these megacaps has flipped. Earlier in the cycle, NVDA carried a bullish sentiment score of plus 0.4. Now, Opal carries a bearish sentiment score of minus 0.41 across 17 articles. This isn't systemic optimism anymore, it's selective skepticism. The put/call ratio in the larger cap space is shifting toward hedging, but it's subtle. It's not the screaming panic of October 2023. It's the quiet unwinding of long duration. Let's look at the small caps. IWM is at $288.57, down 1.64%. SPECTER, what is the risk profile here compared to the large caps?
Small caps are the canary in the coal mine for credit stress, and the curve is sending a bad signal. The 10-year minus 2-year spread is plus 0.45 basis points. The 10Y is 4.67%, and the 2Y is 4.22%. A flat curve historically correlates with slowing growth and impending stress on cyclical sectors. We saw the industrial sector, industrials, fall 3.19% today. IWM is at $288.57, virtually touching the $288.26 5-day low within the 10-day range of $288.26 to $297.81. Small cap liquidity is evaporating. If the Fed cannot cut rates due to that sticky core PCE at 3.29%, small caps face the double whammy of high borrowing costs and slowing demand.
Technically, IWM is in freefall mode relative to its medium-term trend. It closed at $288.57, which is dangerously close to the 5-day low of $288.26. The distance to the 10-day range low is minimal. Unlike SPY, which has some historical support density around 730, IWM is showing pure momentum failure. There is no bid here. The volume in the losers far outweighs the winners, indicating that shorts are controlling the tape in the Russell 2000 space.
Bringing this together, Grid flagged the mechanical failure at the $288.26 support level for IWM, pointing out the lack of bid. But CIPHER highlighted the fundamental driver, that flat yield curve and sticky inflation prevent the Fed from easing, which structurally crushes small-cap valuations. Pulse added that while the VIX remains low at 18.21, the sentiment shift toward bearishness in consumer-facing tech suggests this liquidity evaporation is intentional, not accidental.
Finally, let's look at the outlier. The energy sector, energy. It's up 1.88% to $58.65. Why is this sector defying the broader market drag?
It's a rotation into tangible assets. In a 4.67% yield environment, companies with hard assets and immediate cash flows become premium. The technology sector is down 7.6% for the week, shedding multiples, while the energy sector is gaining ground. The market is effectively trading growth for value and inflation hedges. The divergence between the technology sector and the energy sector is the dominant structural signal. Capital is fleeing rate-sensitive growth in favor of energy infrastructure, which benefits from the same inflationary pressures that are keeping rates high.
The sentiment here is one of defensive aggression. Investors aren't just buying the energy sector, they are selling the technology sector with conviction. The mood is caution, but specifically targeted at duration. The VIX staying at 18.21, while the energy sector rises, shows that this isn't a general market crash. It's a precise surgical removal of overvalued tech. The crowd is rotating, not fleeing entirely. They are moving from one basket to another, seeking shelter in commodities and staples like consumer staples, which is up 3.53% this week.
But remember, this rally in the energy sector is funding the pain elsewhere. As long as the 10-year yield stays at 4.67%, energy acts as the counterweight to the bond market. If yields spike further, energy might eventually succumb to the macro headwinds, but right now, it is the only green light in a red dashboard. The risk is that this divergence narrows violently. If the VIX breaks above 20.31, correlations revert to 1. Everything sells off. Right now, the energy sector is the lifeboat, but if the water rises fast enough, everyone goes down.
So, to summarize the key takeaways from this after-hours session. First, the S&P 500 is testing critical support at $729.10, with SPY at $729.46, facing significant technical and fundamental headwinds as yields hold at 4.67%. Second, we are witnessing a severe sector rotation, with technology shedding 7.6% over the week, while energy gains 1.88%, driven by a shift toward tangible assets and away from duration risk. Third, the VIX remains compressed at 18.21 despite the equity declines, creating a fragile environment where a break in key support levels could lead to rapid, unanchored volatility expansion rather than an orderly correction. Thank you for listening to the ShadowQuant Equities edition. Keep an eye on the GDP and PCE data coming out this afternoon and the University of Michigan's sentiment tomorrow. Until then, stay vigilant. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.